In modern financial markets, algorithmic trading executes thousands of orders in the time a human eye takes to register a single price tick. Institutional capital deploys through fragmented, high-frequency bursts, creating the volatility that characterizes the intraday landscape. Yet many traders approach this environment expecting the market to print highly symmetrical accumulation and distribution schematics, with clean phase boundaries and distinct textbook events. This chart of the S&P 500 futures illustrates the disconnect. The price action here is erratic and heavily fragmented. Attempting to force theoretical labels, like a precise selling climax or a textbook automatic rally, onto these movements often ignores the underlying order flow. When the market fails to produce an exact replica of a Phase A stopping event, rigid traders often hesitate. They sit in analysis paralysis, waiting for a perfect setup, or they deploy capital based on labels that the actual price action does not support. Professional practitioners avoid the pursuit of perfect labeling. They prioritize the identification of macro-structural logic, looking for evidence that the underlying character of the market is shifting. The primary goal of analyzing a potential market bottom is not to perfectly identify the first 4 stopping events. The goal is simply to verify objectively that the prevailing trend has stopped. This chart shows highly erratic price spikes, yet these chaotic lows adhere to a unified logic. By drawing a singular boundary, a creek line, across these points, the noise organizes into a clear resistance level where price repeatedly fails to push higher. Here, we see the price finally breaking above that established red rejection line and sustaining its position. That single action validates the initiation of a sideways accumulation process. Prioritizing the objective migration from a trend to a sideways range provides the necessary context for high-probability setups. It offers a factual analytical advantage that forcing a perfect label on a messy initial stop simply cannot match. Validating these structural shifts requires accurate volume analysis, but applying standard time-based volume to intraday charts introduces a massive hidden flaw. This S&P 500 chart illustrates the problem. Massive volume spikes during US Open contrast sharply with dead zones outside regular hours. Time-based histograms create false positives. A low volume bar might just be a lack of participants during that hour. Conducting a unified structural analysis across both active extended trading hours and dead regular trading hours severely skews the data, leading to incorrect assumptions about institutional intent. Pure price action, however, is the unfiltered ledger. It graphically represents all executed orders, independent of the session clock. To get an accurate reading, we need to view volume the way we view price. This tick chart demonstrates the solution. By removing the time variable entirely and generating new bars only after a set number of transactions occur, we filter out temporal noise. Notice the uniform volume bars across the bottom axis. Alternatively, a range chart measures pure price movement distance. Every bar has an identical vertical height. In high volatility environments, more bars generate quickly. In low volatility, they generate slowly. The visual representation of market effort is equalized. Shifting from time-dependent charts to transactional charts aligns your analysis with actual liquidity deployment. You stop measuring clock-based sessions and start measuring genuine institutional effort. Once a range is validated by multiple successful touches on opposing supply and demand zones, the baseline expectation is set. The market should continue traversing back and forth between those established extremes. A structural failure occurs when the price cannot complete its expected traversal. It turns before reaching the opposite side of the range, offering an early footprint of shifting market control. This diagram shows a clear example of structural weakness. After respecting the boundaries, the price turns downward at the question mark, falling short of the red upper boundary. This occurs because sellers are stepping in aggressively at lower valuations. The buyers have lost control of the auction, and the supply is overwhelming the demand long before the established resistance level is reached. Conversely, look at this diagram illustrating structural strength. In the lower right quadrant, the price reverses upward before it can touch the green lower boundary. This indicates buyers possess a higher interest rate. They are deliberately absorbing supply at higher valuations to block other participants from entering the market at cheaper prices. Recognizing a failure to traverse these boundaries provides a critical preemptive signal. It reveals exactly who is absorbing liquidity right before a major breakout occurs. Beyond structural failures within a range, we can also measure the mathematical exhaustion of an active trend, using a concept originally defined by. In the first example, each successive low travels a shorter distance, proving momentum decay. The second example shows bullish compression. When paired with high volume, it signals effort versus result divergence, massive institutional effort yielding no actual ground. This localized exhaustion is a leading indicator. The forces that previously controlled the market are being absorbed, telegraphing an imminent structural pullback or a complete trend reversal. Identifying compressing price geometry at these extremes protects you from deploying capital at the worst possible moment. You avoid buying into the absolute top of a dying trend. A common misconception is that consolidation must always occur within perfectly horizontal boundaries. The market is not obligated to draw flat lines. The continuous, unbalanced interaction between supply and demand frequently generates diagonal or sloping structures. This upward-sloping accumulation structure contains chaotic price swings within parallel diagonal boundaries. Its internal behavior is mathematically identical to a horizontal range. Look at touch points 1 and 2. The asset respects this diagonal structure with exact precision, cycling through the identical phases of consolidation. This upward tilt exposes extreme underlying buyer strength. The buyers are aggressively building their positions and refusing to allow the asset to drop into deep oversold territory to do it. Psychologically, these structures are difficult to trade. When the final entry point arrives, the price is already sitting at a subjectively high valuation, making it feel highly dangerous to buy. But recognizing the angle of the consolidation structure instantly reveals the control bias. You know exactly which side the institutions favor long before the actual breakout leaves the station. There is a harsh reality to advanced trading. You can perfectly identify the momentum decay, accurately track the structural logic, and still watch the trade collapse. Confirmed setups can and do fail. Looking at this diagram, we see the anatomy of a failure. The price establishes a clear range, but at the crucial moment marked by the question mark, it fails to maintain its structural logic and immediately plummets. This happens because short-term buyers, who entered at the bottom of the range, often close their positions at the top to capture local liquidity. That sudden exit abruptly eliminates the upward momentum, but there is a secondary, far more dangerous threat. Higher timeframe participants track these highly visible liquidity zones. At the exact moment retail traders buy the breakout, these larger players step in to execute massive counter-directional sell orders. This sudden influx of massive capital instantly rotates what appeared to be a confirmed accumulation structure into a distributive one. Surviving false breakouts requires accepting that market control is fluid. It is constantly subject to sudden, higher timeframe intervention. Because no trader can predict exactly when a larger institution will step in to rotate a structure, standard breakout trading is highly vulnerable. You need a defensive anchor. Practitioners anchor directional bias to the shakeout. Focus on the two extreme outliers past the boundaries, the upthrust and spring. These indicate structural intent, representing aggressive liquidity absorption. As noted, a validated upthrust favors a subsequent visit to the structure's minimum. By contextualizing every sign of structural failure and momentum decay strictly against the direction of the last major shakeout, you drastically filter out the market noise. A rigid trader might see an exhausted upward slope and blindly try to buy the dip. The advanced practitioner will short that exact same slope because they anchored their bias to the massive upthrust that preceded it. Mastering market dynamics requires abandoning the hunt for perfect textbook labels. True edge comes from reading the underlying geometry of failure, exhaustion, and institutional liquidity absorption.